Very good morning to you all. Today we are going to discuss a topic on financial analysis. So here that financial analysis in the sense to analyzing the financial position of the business organization. So every company will having to know about the strengths and weaknesses. So here that under this financial analysis we can assess the profit and loss account of the firm, and we also know about the financial position of the company through a balance sheet and liabilities and assets. So through this profit and loss account then we can assess the net profit of the company and the net loss. So then we can assess through a balance sheet, so how many liabilities are there and what are the assets of the company. If assets are more than that of liabilities or liabilities are more than that of the assets, so always we are having an excess of assets than to the liabilities, then we will having a good financial position of the company. So if liabilities are more than the assets, then we are having a shortage of finance. We are having to we are unable to meet and repay the debt amount to others. So that's what we always be in a good financial position, then always we maintain our assets and more than that of their liabilities. So here under that financial analysis we can go to cover over the topics of types of financial statements, objectives of financial analysis, and the significance of financial analysis and methods of financial analysis. Now we can go to check over these types of financial statement. We are having the income statements and the statement of affairs. So now come to the income statements or income statements of the company. So here under this income statements we are going to prepare over the profit and loss accounts. This income statement is only popularly known as the profit and loss account. It includes manufacturing accounts, trading accounts, and profit and loss account. It represents the cost of production, cost of sales, and finally net operating income and net profit during the year. So that means if the company has to reveal the financial position that might regarding over the net profit or the net loss of the organization during a financial year. So it shows the profitability performance of the business. If the company will having a to get a net profit, then what we can call, if the company will having a good performance, a good financial performance in the organization. Okay, so now the second is financial statement is for statement of affairs. So here under the statement of affairs we can popularly known as the balance sheet. So we all know, so balance sheet only reveals the financial performance and financial position of the organization. So here under this balance sheet we are having liabilities and assets. So here under that liabilities on one hand and other hand liabilities we can showcase on one hand, and other hand side we can showcase as assets. From here under the asset side we can list out all the current assets and fixed assets. If any depreciation is there we can subtract over for it and we can make the total. And while come to the liability side we can list out all the liabilities. So all the liabilities we can mention like bills payable, bank overdraft, creditors. So these all we can mention over on the liability side. On the asset side all the current asset like cash, bank, debtors, and if any bad debts is there we can subtract it, and furniture and fittings and machineries, equipments, if any depreciation will be there, and we have to subtract to get over the amount, and we have to make a total of the balance sheet. Through that we can assess if the assets are will having a good if the assets are more will having for the company, liabilities are more. If the both will be balanced and no problem at all. If liabilities will be more than that of assets, if the company will be having to occurring and running their business into a loss, that is the indication to know the financial position of the company. Okay, so now we can check over the another concept is for significance of financial analysis. So why should we go to analyze the finance? So definitely we have to analyze the financial situation. We can monitor it and we can evaluate the performance of the organization. So because so we are having a significance and importance for these financial statements. Through that only we can rectify if any financial crisis and problems we can face in the future also. So then we have to overcome that. We want to take precautions and remedies to overcome all the situation that was happened into the future. So then we have to go and monitor it, and we can evaluate it, and we can analyze the financial situations through the state with the help of these statements, and we can evaluate every financial year, and we can also compare with the other forms also. So we can discuss further. So now we can discuss over for this importance of this financial analysis. The first important thing is to know the operational efficiency of the firm. So through this financial analysis, we have to know the operational efficiency. If so and so business organization will operating their business organization efficiently or not. So efficiency of operation in the sense the company will the company is having a sufficient amount of liquidate capital, if the company is able to meet their short term operating expenses, if the company is doing their production activities properly, if the company is well generating their sales properly, if the company is getting returns as per their expectations or not, if the company is expected to go for any diversification of their business, how much of capital they might be required, if that capital is also having for that company in a sufficient level or not. So everything they have to go for check their efficiency of the company. So operational efficiency in the sense in what level the company will be operating, what level they can meet their expenditure, what about their inflows and outflows of the organization. So always we think the cash inflows are more than that of outflows. We make our inflows will be more than to the outflows, that in the sense of our income returns or retained earnings and the returns of the organization that might be more while compared to the outflows like as expenditure we can make through. Okay, so these are all the main important elements. Through this financial analysis we can assess it. And the second important thing is for helpful in measuring the solvency of the firm. This financial analysis is also helpful to measure the solvency. If so and so a particular firm will be a solvent or insolvent, how can we assess it to know the financial position? If the firm is able to meet their operating expenses, if the firm will having a amount of fund and capital, they should can reinvest, or they can go for employing their funds from other sources. If they are maintaining the sufficient liquidate amount, if the rest of that amount they can go for employing onto the fixed assets. What about their short term decisions and the long term decisions? What about the production they have to made in the organizations, and what the returns they were get? So they can, while measuring all these things, and we have to know the solvency of the firm. If the firm will be solvent, how can we measure? Through their financial capability. If the firm will have to generating more and more returns, if the firm is generating more returns, so in the sense, so their sales might be increases, they are getting more profits. If the company is earning more profits, in the sense the company will be in a solvency position. If not, their production cost is more than to their sales, so all the stock might be outdated, so no one is there to purchase their products and services. All the production might be gone to loss. So that is the riskiest position that was having for a firm. The reason behind that is we are not measuring the company's position. Then we have to check so what type of product we are manufacturing, what the customers will be interested, if the product will having a demand or not. So then we can check to go for doing the production. If not, we are spending more and more investment on the production, and while manufacturing the more and products that might be released in the market, but the customers, no one is interested to go for purchasing of those products, then what it will be happen? The entire investment will be gone to loss. The loss and failure of this will lead to insolvency position. So insolvency position in the sense that might we can consider it as the company is ready to winding up. So then we need not to face all these consequences, all these things in the future. So then we have to measure the solvency. Okay, the company will having a good solvency position, then we can measure through the profits. If more profits, the company will having a good solvency. If the less profits will lead to that companies is slowly and gradually declining their sales, that in the sense no profits was generated. If there is no profits, in the sense how can we reinvest the business, how can we improve our business? Again we can go for reinvesting of our own amount, or we can get from other sources like as banks, and we can go for borrow the amount from other money lenders, and we can get over from the debenture holders, that all might be repaid, and we again we can go for give payback through is in an interest form to others. So that is also an expenditure. So that is also the expenditure. So in the sense what so that means the company doesn't be having a solvency, the company is slowly moving into losses. So then what we have to do, so what best measures we can take to control over the business? So then what we have to do, so that's the things we have to rectify to take and control over the business organization. That is only possible, then we have to measure the business financial performance. If you are not measuring all these things, so then after doing of all these things, after declining of sales, if we are run into losses, then we can take any, that's if we can take any of the measures, that might not be useful. So then the reason for analyzing the financial capability is to we can make our firm, it might be a solvency rather than insolvent. Okay, the next one is for comparison of past and present result. So through this financial statement we can compare with the past sales and the present sales of the company. In the sense here under this financial statements we are having for a comparative income statements and comparative balance sheet, like as a common size income and common size balance sheet. Through this comparative balance sheet what we can do, so they simply we can take the 2 years data from 2011 or 2012 or 2015 or 16, while we can take the 2 years of data. So then we can compare over for the what about the fixed asset rate, then we can take over the fixed assets. Then what about the furniture we can purchasing from 2011, what is the value for 2012, it is increases or decreases, then we can mention over onto the increasing and decreasing level. And next we can go for calculating the absolute percentage change on the comparative balance sheet, and we can take the difference amount divided by previous year amount into 100, then we have to get the absolute change. So like that we are preparing the comparative balance sheet. That means what, so through that we can able to check and assess over the difference between the past year sales and to the present year sale, past year cost of expenditure and present year cost of expenditure. So then you can easily measure in what level the change that was occurred from the previous and present company performance. So that is helpful for assessing to predict the future also. Okay, so that's helpful for a comparison of past and present result, that is only possible through the comparative balance sheet. So here under the common size balance sheet also we can measure, then we have to here we can measure only from year to year. So but here on common size balance sheet we have to take the base of a balance sheet. So balance sheet is given, so under the 2011 the total asset, the total liabilities they were mentioned, and the 2012 their total liabilities they were mentioned, and like as assets 2011 total is mentioned and 2012 total is also mentioned. So they can mention over their total, then we have to consider that is the base value. So every assets and every liabilities we can go for mentioning over a common size balance sheet, then we have to consider the base value is for the balance sheet value. So in the sense the fixed assets we are taking under the common size balance sheet. The fixed assets might from this 2011 year, that is for 10,000, and the 2012 that is for 15,000. 5,000 is the difference. So this 5,000 difference we need not to shown onto the common size, but this difference value we can shown in the comparative balance sheet. In the common size what we have to do, so simply we can take the 2011 fixed asset value is 10,000 rupees, and what is the percentage of change in the year of 2011. Then what we can take the amount divided by what is the 2011 value under the balance sheet from the side of liabilities, the total value into 100. So then we have to get the percentage from the year of 2011. As same as we can go to take over the 2012 also. So at that time we can take over the overall percentage of change from last year to and current year. So like that we have to compare over from the last year sales, present year sales, and last year financial performance, or last year profits and the present year profits. Through that everything will be measured only for the financial performance of the organization. Next one is for helps in measuring the profitability. So this financial analysis helps to measure the profitability of the organization. What about under the income statements will tells about to assess the profit and loss account. So here in the while preparation of the final accounts, we definitely go for preparing the trading account. Through we can assess the gross profit, gross loss. While we can go for preparing the profit and loss account, we can assess the net profit or net loss. As same as we can go for preparing the balance sheet, and then we can assess the financial position of the company. So here this financial analysis will help to measure the profitability. If the company will be in a good profitable position or not, then we can assess through the income statement while we getting the net profit or net loss. If we can get the net loss, the company will not having a good profitable position, that might be in a losses. We want to make a good profitable position, then we always be go for minimizing the wastage and minimizing the wastage of expenditure, and we can maximize the output level and getting the more returns for the company. And we have to take the best decision that might regarding to a finance point of view. Okay, helps in judging the solvency of the undertaking. So always we can go for judge the solvency. That means the company will be a solvent or insolvent. How can we know? So based on the financial position, if the company will having a good financial position, in the sense the company might be a solvent. If that if the company doesn't having a good financial position, that might want ready to insolvency. So always the assets are more than the liabilities, then we are in a solvency. So if the liabilities are more than assets, in the sense we are having a insolvency. Insolvency leads to winding up of the business organization. And next one is bankruptcy and failure. So then we have to overcome this bankruptcy and failures. Bankruptcy is nothing but to wind up the business. So then failures, so that means we are taking the loans from the banks and financial institutions. So then we are taking the loans from the banks and financial institutions. Then what it will be happen, then we are unable to repay at that situation. So then we can go for a failure. So then what we have to do, the bankruptcy is helpful to uh, then bankruptcy means we are unable to meet the expenditures. So we are unable to repay the loans, we are unable to repay the any liabilities of the organization. Okay, so next one is having for a helps in forecasting. So then with the help of this financial statement analysis, we with the help of this financial statement analysis, we can forecast the future. We can forecast the future. That means what the steps we have to taken into the future to control over the business organization. Here the forecasting in essence estimation of future. The future is uncertain, we don't know what it will be happen. So we don't know what it will be happen in the future. So that's what we have to take the right steps to taking the right decision in the finance point of view. We can control over the business in the future also, because risk means we that is certain we can control it, but future is uncertain, we can't control over for the that's not in our hands. That is risk will be happen suddenly. So for that we can overcome all these things, and definitely we have to control the organization for proper maintenance of finance, and sufficient finance is helpful for the organization to maintain the proper financial position. Thank you.